China and the BRICS nations' appetite for gold and silver is so strong that they're taking all available inventory. The COMEX will not survive in its current form because it's being drained. China refines two-thirds of the world's silver. They're net importers of silver now. So it means that China is two-thirds plus taking all of the silver for their industry. They're not letting it go. They're like, hey, we'll refine it, but then they don't sell it. And so I think within the year, we're going to have an acute silver shortage around the world because China's hogging a bunch of it.
I think generally, I mean, it's not new that all the gold is moving from the west to the east, right?
Yeah.
And of course, Singapore wants to play a part of that. I'm more focused, to be honest, on what is going on in Hong Kong. Okay. I think the Chinese building a second gold hub there. I went to bed with gold trading at 4,075, and I woke up, it traded $65 higher already. And then it seems that it triggered a short squeeze in the Western markets.
The global precious metals market is undergoing a structural transformation as physical supply continuously flows from Western vaults into Eastern hands. Central banks and sovereign institutions across Asia are aggressively accumulating physical gold and silver, exposing critical vulnerabilities in paper-based financial systems. Rob Kientz, an authority on precious metals research, and Florian Grummes, a prominent financial strategist, highlight how Eastern dominance is rapidly stripping Western exchanges of real physical inventory. China refines over two-thirds of global silver and has shifted to a net importer to sustain its expanding industrial sector. By restricting exports and eliminating retail paper trading, Chinese policy is locking down physical metal at the source. As Western exchanges rely heavily on leveraged paper derivatives, physical reserves are disappearing from vaults. Based on these supply constraints, it is predicted that the world will suffer an acute silver shortage within the year. Furthermore, predictions show that the COMEX will fail to survive in its current form as BRICS nations absorb remaining global inventories, permanently altering precious metals trading. Now, we present the clips from their interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
Going beyond the central banks, if you look at what's going on in Asia, China and Hong Kong have come to an agreement on the Hong Kong Gold Gateway. Hong Kong is a huge market for gold and silver. They're a huge jewelry producer. They also do industrial grade bars in gold and in silver.
Yeah.
And a lot of the previous Chinese exports would go to Hong Kong for making in jewelry, and then most of it would go back to China. Well, now China has just formalized, and Hong Kong have formalized that relationship and said, okay, well, heck, let's build a system that links Hong Kong's gold trade and vaults with Chinese manufacturing. And they have a system, a information system for that. And now they're in an agreement that they're going to join forces. And this, if you remember previous episodes, I probably talked about this, I would imagine. 5 or 6 years ago, when I was at Silver Symposium in Coeur d'Alene, Idaho, which is an industry conference here in the US, was at the time the longest running one. I reported that it was in the news. I believe it was Business Insider that had reported that China had engaged JP Morgan as a consultant for their commodities, not only gold and silver, but their commodities, the Shanghai exchange, the broader exchange. And so now China's kind of gone through a redevelopment of the Shanghai exchange, and a lot of things have happened. You've got the export restrictions on silver. Now you have to be a licensed, government-approved organization to export silver. So China's wrapped its, government branch around the silver trade. They have also, there is an approval process for getting on the Shanghai exchange. China's removed most of the paper trade. So if you look at the London market, the LBMA, and you look at the New York market, the COMEX, they're primarily a paper-driven market. China has locked it down to where 50% of their trade on their markets has to be in gold, and they've removed retail exposure to futures trading, meaning they're removing paper, they're removing people out of their gold market that don't either produce it, use it, or are manufacturing it or mining it or whatever. And so the leverage trade in Chinese market's been shrunk. So the US is moving to almost a completely derivative-driven market where physical has nothing whatsoever to do with prices. And LBMA is already there. They're already leveraged 100 to 1, according to most analysts who actually live on that market. And then you've got China going the opposite direction saying, we want more of the physical trade. Not only that, we're going to do these partnerships around Asia. Now in Singapore, the Singapore market is developing futures markets for gold and silver. And so that now that you can have the Shanghai Futures Exchange, because there's two Shanghai exchanges, the physical and the futures. So China does have futures, but they've cordoned it off from physical. Okay. So you can play futures in China, but it's not dictating the price of Chinese gold. Well, investor confidence is going to go east because if you look at the liquidations on COMEX for gold and silver, we are down 9 or 10 million ounces of gold registered and eligible. We're down to 100 million ounces of registered silver. This is after a big buildup in silver in 2025. So we're being drained. You're seeing that physical trade move over to the east through Singapore, Hong Kong, China. Even Russia's getting that. Russia's trading 3 times as much gold in their market as they were before. So the BRICS nations are enhancing and building infrastructure around their gold trade, and they're starting to have a lot more credibility. They're closer to what the physically settled price should be because they actually settle physically. Dubai does as well. And the West is a paper-driven market in which there are large interests that manipulate that market for their purposes, both financial, banking, and other large players. So I think, Lucian, the Western market what's going to happen is people are going to look at that like a fugazi. They're going to look at that like you have nothing to do with the trade. Why do we care? And in the East and in the BRICS nations, you're seeing them embrace the physical and say the physical is important. And China's building ETFs for the retail segment so that retail investors can get in. I don't know if there's going to be convertibility, but it doesn't matter because that ETF is going to suck gold out of the trade market. So China has developed a mechanism to not only suck all the gold and silver in, but then to have marketplaces that they control, their portion of the gold, who it goes to, and that's going to dictate prices on that side of the world. And we're getting to what I said last time is regionalized markets. And they're going to have a lot more credibility with actual gold market participants than New York or London has. New York or London, it's like the clothes are off the emperor, right? We see you're naked. And I don't think people trust it as much. And once the COMEX finally runs down to emergency levels of gold and silver, which is what's happening, it will eventually happen if China and the BRICS nations' appetite for gold and silver is so strong that they're taking all available inventory, the COMEX will not survive in its current form because it's being drained.
Yeah.
And China, one other thing I want to say about China refines 2/3 of the world's silver. They're net importers of silver now. So it means that China is 2/3 plus taking all of the silver for their industry. They're not letting it go. They're like, hey, we'll refine it, but then they don't sell it. And so I think within the year, we're going to have an acute silver shortage around the world because China's hogging a bunch of it. And I mean, what's the US going to do? It's a critical mineral, but have we permitted any new big mines? Not yet. So yeah, the East is taking over the gold and silver trade, and eventually that pricing duopoly between COMEX and LBMA is going to fall. It's just a matter of time. And I think the East is going to have much more, and the Middle East as well, is going to have much more credibility with respect to precious metals than the West will.
A powerful trade partnership between Hong Kong and Shanghai is formalizing Asia's main gold gateway. This integrated system connects physical bullion vaults directly with manufacturing hubs, creating a robust alternative to the London and New York financial axis. By removing speculative retail leverage and mandating physical asset backing, Eastern markets are insulating themselves from Western debt instability. Singapore is also expanding its regional futures contracts to support this growing demand for physically settled bullion. International entities are increasingly turning toward these transparent hubs to execute cross-border settlements outside the US dollar ecosystem. Regarding short-term market momentum, predictions indicate silver will break out of its recent consolidation phase to reach a summer target of $70 per ounce. This anticipated multi-month rally offers prime capital deployment opportunities in silver mining equities before broader market participation drives prices higher. Now, let's get back to the interview.
I think generally, I mean, it's not new that all the gold is moving from the west to the east, right? Yeah. And of course, Singapore wants to play a part of that. I'm more focused, to be honest, on what is going on in Hong Kong. I think the Chinese building a second gold hub there, basically something similar to the axis in the West, London and New York. Now you have Shanghai and Hong Kong. And for international investors, international companies, it's much easier to do banking and all the legal works, the business setup in Hong Kong than in Shanghai. So, and with the massive strength of China behind it, I think Hong Kong will be the second important gold hub in Asia. But it's often definitely interesting, and it's good for the industry that Singapore is doing it as well. So let's see how this evolves. Again, I think my focus will be on Shanghai and Hong Kong for many years already.
Yeah.
All your guests as well. I mean, it's clear the Chinese, the Asians, they want to get rid of the dollar, or at least they want to have an alternative. They need an alternative. It's very clear now. If you look at geopolitics, it's the West against the East. It's America against China, and this will continue. And for that, they building these gold hubs, these gold trading facilities to make sure that they can do business with each other without using the US dollar. That's the main goal, I think, in the end of the day. And it's proceeding step by step, while most of the music has been playing in that bull market in the Asian sessions. And I mean, that will continue. And best example is tonight. I mean, look, I went to bed with gold trading at 4,075. And I woke up, it traded $65 higher already. And then it seems that it triggered a short squeeze in the Western markets. So, I think the music is clearly playing in the East, and that's where the gold price is being made, because it's the physical market. And as you know, it's not long ago, the Chinese basically decided to not allow any more retail products based on paper trading. So it all has to be backed physical. And that's one of the attacks by the Chinese against the Western dollar system. Silver is always lagging and running behind gold 80 to 90% of the time. And then at these final innings of a bull run, silver shows up and outperforms gold dramatically. And we've seen that if you go back the time from, let's say, last October into end of January, silver was just going nuts. And that is the special situation in silver, where it creates that outperformance. But most of the time, it's just following gold. But it looks good too. And I have a target for silver here for the summer at $70. I think that's realistic. We touched the 50-day moving average today around 63. I think the high today was 62.77. So I think it's also the breakout here out of this sideways range, this bottom building. So I think it's bullish in the short term over maybe the next, ideally we have a few weeks, maybe 1 to 3 months for that nice bounce and rally. And then we have to reassess later in autumn. It looks bullish here. I think also the silver mining stocks are interesting now again. It's time to deploy cash again. The Forex market, trading these different currencies against each other, I have stopped that since 15 years already, or even longer. I think the moves are rather marginal most of the time. It's a very tricky, very international, large market. I'm trading gold most of the time. And we had this stronger dollar, but we didn't really see a very strong dollar really over the last few weeks. I think the Japanese deal here with the Fed has some influence. I think it's inflationary. It changes the plumbing of the financial system. It obviously creates more dollars, which then can chase all these assets like stocks, like metals, like Bitcoin. But it is not necessarily meaning that the dollar has to become weaker again. I don't care too much, because look, if I go back and look what the dollar has done over the last 15 years and where gold started to trade, 15 years ago, we had that low in gold around $1,000, and now it's up 4x. And while the currency exchange for the dollar against the euro, which is the main pair within that DXY kind of basket, didn't change as much. So I think it doesn't really matter.
Deepening geopolitical fractures between major global economic powers are accelerating the urgent search for viable alternatives to the US dollar. While Western exchanges like the LBMA operate on extreme leverage ratios exceeding 100 to 1, physical gold and silver are steadily migrating to physical settlement hubs across Dubai, Singapore, and Russia. This structural pivot is transferring real price discovery into Asian trading hours, where overnight surges regularly trigger massive short squeezes on paper-driven Western exchanges. Eastern institutions are reinforcing this monetary shift by launching retail physical gold ETFs, effectively locking up available bullion and removing key assets from global trade circulation. Furthermore, central bank diversification into physical bullion signals an irreversible transition toward gold-backed trade settlement across emerging markets. While silver typically lags behind gold during the initial stages of a precious metals bull run, historical cycles predict that silver will dramatically outperform gold during the final innings of this rally. As the traditional pricing duopoly controlled by COMEX and LBMA breaks down under acute physical drain, market participants holding tangible assets stand to capture long-term economic value. Share your thoughts about this interview in the comments section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.